Well, good evening, everyone, and thank you for joining our session tonight. Tonight, I've been asked to look at task 6 of the AMAC AAT assessment, typical contents, and usually this task deals with investment appraisal, by which we use the techniques of discounted cash flow, net present value, internal rate of return, accounting rate of return, and we also frequently will calculate payback. So let's have a look at what we mean by these. Okay, task 6 deals with long-term decision making. This task is worth 14 marks, which gives you 18 minutes to complete it. So long-term decision making really is, should we buy the new machine? Should we open the new factory? As opposed to short-term decision making, which is out of our 3 products, which is the one we should make the most of if we are perhaps short of materials or labour. So task briefing. Discounted cash flows, in very simple terms, the time value of money means the longer you have to wait for cash flow, the less it is really worth to you, as you are losing the opportunity to earn interest. I've got an illustration of that, which we'll look at in a second. Discount factors are figures that take into account the time value of money and are expressed as decimals. We calculate these by reference to the company's cost of capital, for instance, the interest rate we're paying borrowing. Let's just flip forward and have a look at how we arrive at these. The discount factors are the factors that we apply to future cash inflows to convert them to what they're worth today. Now, imagine that the banks are paying 10% interest. Highly unlikely, I know. But that would mean that if we put £1,000 in the bank today, in a year's time, it would be worth 1,100. If we left it there in 2 years' time with compound interest, 1210. By year 3, we would be looking at £1,331 in the bank. So it's fair to say, on that basis, somebody who gives us £1,331 in 3 years' time, that has the same value as if we had £1,000 today. So we can actually do a mathematical exercise to each of these future cash flows. If these, rather than being the money that we have in the bank, if these represented cash flows coming into us in the future, we can convert them back. Our 1,100 received in year 1, if we divide that by 1,100, multiply it by 1,000, that takes us back to 1,000. So if we, my apologies. Got a sticker here to remind me to do that as well. Okay, so 1,000 over 1,100, if we calculate that out as a decimal, that gives us 0.909, which, if you've done practice exercises involving use of discount factors, will probably ring a bell, because that is the 10% discount factor for year 1. If we look at our year 2 figure, by year 2, our £1,000 has grown to 1210. If we divide 1210 by 1210, multiply by 1,000, that will take us back to £1,000 once again. If we convert 1,000 over 1210 to a decimal, what do you know? We get 0.826, which again, if you've done practice exercises using a 10% cost of capital, which is, if you like, the other side of the 10% interest coin, 10% interest payable equates to 10% cost of capital if it's chargeable. And the same again if we do year 3. By year 3, our 1,000 has grown to 1,331. If we multiply 1,331 by 1,000, divide by 1331, that takes us back to our 1,000. And sure enough, 1,000 over 1,331 gives us a decimal of 0.751. So now you know where those discount factors that you are given in the exercises come from. And if it was a 15% cost of capital, same exercise, year one would actually be 100 over 100 plus 15. So I'm just taking the zero off there. 100 over 110 at 10% is the same. Year two would be 100 over 115 times 100 over 115. And so on for every year, because you see that's the other way we can express this calculation. The calculation we have done here, 1000 over 1100, is essentially, we take a zero off each, 100 over 100 plus 10. Year two, take off a zero, it's 100 over 100 plus 10 times 100 plus 10. And year three is just divided again, or multiplied by 100 plus 10, which underneath the line is effectively divided. So now you can work out your own factors. 12%, 100 over 112, and then again squared, cubed, times itself, times itself. So there we go. Let's go back. Net present value, having talked about how we discount future cash flows, our net present value, we should talk first of all about what present value is. Present value is today's value of the future cash flow. So the present value of 1210 in year two is £1,000. That's our present value of that. Net present value is what we get when we sum up all of the cash flows for a project. The initial cash outflow, which we express as a negative because it's cash going out, and then added into that all of the cash inflows. And if we find that all of those inflows after discounting are greater than what's gone out at the start, then we say that our net present value is positive. The money coming back in is earning more than the required rate of interest, is another way of putting that. And step one, identify cash flows. Notice the important word relevant. We only take into account cash flows that will take place if the project goes ahead, because quite often we're doing this exercise based on hypothetical figures. It's not looking at something that has happened. We're looking at something that we might do, that might happen. So identify relevant cash flows that are affected by whether or not the project goes ahead. Group them normally by year. Add up total for each year and then multiply by the relevant discount factor to give the present value for each year, which is what we've just done. Add them all together to give a net figure. If it's greater than zero, then it's earning at greater than the cost of capital. If it's less than zero, it's earning at less. So generally that means accept if positive, reject if not. Variations on this net present cost. We don't always buy assets. We don't always invest in a project. Sometimes we're trying to establish what's the most cost-effective way of fulfilling a need. The most obvious example that springs to mind is maybe we need to replace a fleet of delivery vehicles. We can either buy them, so we might lay out £100,000 to buy these vehicles, and then we'll look at what it then costs us to run them and maintain them. But of course, the cost at the start is in today's value. The future cost we would discount. And we're going to always have a negative figure, of course, with the net present cost. So for that reason, whereas if we're doing an NPV analysis, we tend to show inflows as positive and outflows as negative. With NPC, it is customary to do it the other way around because most things are outflows. So the cost is positive. If there are any inflows, such as maybe savings, there might be savings, then they reduce the cost. So they're shown as negative. Net present cost, we're looking for, having said we might buy our fleet of delivery vans, our other option would be to lease them. So instead of a big outflow at the start and then modest outflows, we would end up with a substantial outflow on each of maybe the 4 years of the lease. But we can compare the two to see which in real terms in today's money is the more expensive. Net terminal cost is a way of looking back at the cost of the project right up at the end of it. We're looking back, so which has cost us the most over a period of time. That's less common than the other two. And lease or buy, we've just talked about. Okay. Now, internal rate of return. I've done a little bit of a graphic here. The internal rate of return is the discount factor which gives a zero NPV. In simple terms, the IRR tells us the actual percentage return the project generates. Essentially, if we are saying we've got a choice of we can put £1,000 in the bank or we put £1,000 into our project, if whatever internal rate of return our project earns, that is exactly equivalent to putting the money in the bank and earning that amount of interest. Now, the scary bit, when we're asked to calculate an internal rate of return, they give us this horrendous looking formula, and it does look quite scary. In fact, if we look at what all the bits mean, our internal rate of return is, well, let's talk about what we do is, L is we use a low cost of capital. And in this example, we've used 10%. So we've done the exercise that we did in the previous page of discounting all our future cash flows using a cost of capital of 10%. And NPVL is the result of that, the resulting NPV. And in this case, our NPVL has actually come out at about £6,100 in this particular example. It's a little tiny bit over 6,100. H is we then arbitrarily pick another cost of capital, the higher cost of capital, and in this case we've picked 15%. Let's do that in green for clarity. 10% in red. And so our higher cost of capital, we have used 15%. And remember, this is we're trying to find out what a project is earning. So we're not comparing to the rate of return we've been asked to achieve. We're trying to find out what's really happening. And NPVH is the result using the higher cost of capital. And the higher the cost of capital, the greater the discounting of future cash flows. With no discounting, almost every project will have a positive net present value because the future cash flows will be greater than what's paid out at the start. As we discount, the value of future cash flows starts to fall. Eventually, we reach a point where we discount it so heavily, and as has happened here, we end up with a negative figure. And in this case, this is actually round about, it's about minus 6,100. So logically, the IRR has to be somewhere between a cost of capital that gives a substantial positive result and another that gives a substantial negative, and the actual IRR will be in between the two. And all this formula says is that the IRR is the lower figure, it's 10%, plus this far along this line, so it's actually, I haven't drawn that very well. It's about halfway. So distance along times the difference between H and L. Now the difference between 10 and 5 is 5. And we're about halfway along. So what that formula says is our actual IRR is 10% here, plus about half of the difference, because we're about halfway down that line, and the difference is 5. And therefore, 10 plus 2.5, so our IRR is about 12.5%. And that is approximately where it's crossing the line. And that is all that that formula is saying. So as long as you know what L means, know what H means, we won't go into too much on this, because if we're honest, actually that's more like that. This assumes that that line is straight, and actually it is slightly dished. So we would find that if we ran the actual data that had given us these NPVs, we would find it came out fractionally under 12.5. But this is the method AAT are expecting us to use. And as long as your higher and lower are close enough, you can get a very accurate result. If you've got a spreadsheet and ever in real life you need to calculate a precise IRR, you simply narrow in. You would try, let's try 12, let's try 13, try 12.2, 0.4, 12.6, and you would eventually get to 0. Spreadsheets make that easy, of course, but that's the logic of what that formula means. And I've been looking at that formula for a long time, and I've done a fair bit of maths in my life, but I'm sure I'm not the only person here who looks at that and feels a bit uncomfortable because it looks a bit scary. So know your enemy. It's not that bad. Counting rate of return is broadly similar in some respects, but now we're simply looking at our average annual profit over our total investment. So essentially our annual profit is all of our cash inflows, less depreciation, which of course isn't cash, and is the bit we easily forget, divided by length of project. And this gives an indication of how efficient the project is generating profits from how much capital investment. Total investment generally is often the average amount invested. So watch out for an example that where the amount of investment varies. And don't forget the depreciation. That's the bit. That is the bit that is easily forgotten. Now, payback month is how long it takes the net cash flows from an investment to repay the initial investment. So in this case, we start off, we pay out 100,000. Each year money comes in, and eventually the cumulative cash flow, the cash flow to date, eventually we've had 100 back and then more. So that is our payback point. Now, if we look at some data here, initially we pay out 100,000. At that point, we're 100,000 down. First year we get 28 back. It's now 72. 28 again, 44. 28 again, 16. In the fourth year we get another 28. We finish with minus 12. We're normally asked to calculate how many years and how many months. before we look at months in the text box, can you all tell me how many years we think the payback is, how many years, and we'll work out the months in a minute, just to make sure we're all here. Let me have some figures for years. How many years plus? Okay, one answer. Excellent, excellent. This is great. I'm pleased to see this. A very popular error. Brilliant. Yep, you're all spot on. A very popular error is to say that, oh, because we've achieved payback after the 4th year, that it's 4 years. Very, very popular. But it isn't. It is, sure enough, 1 year, 2 years, 3 years have elapsed, plus a number of months. And I've done a proper graph for this. So there we can see it's 3 years. As to how many months, well, during that 4th year, we have a movement of 28,000, which equates to 28,000 over 12, 2,333 per month. The distance we have to travel at the end of the 3rd year is still 16. So here we are, we're still at 16 at this point. So 16,000 over 2,333. 6.8, which therefore we would call 7 months. Again, popular errors there are to use the 12 instead of the 16, but at the end of the 3rd year, you've another 16 still to go. So, yep, it's the year before you've paid back, and it's how many months you've still got to go. 2 very, very popular errors on that. Oh, we don't need that one as well because we've just done that. Okay, 1 or 2 advantages and disadvantages of each method. Okay, net present value, it allows for time value of money. The old saying, a bird in the hand is worth 2 in the bush. Shows change in shareholders' wealth. Yes, because the same money in future is worth less, so it compensates again. It's all about the time value of money. Here's an interesting one. It can allow for risk. If we have 2 projects, one project, very, very safe bet. I don't know, maybe we've got a chain of 10 shops all doing well. Shall we open an 11th on exactly the same patterns, the others, same sort of locations, same products? We'll even move some staff in to start it up from our successful original shops. Pretty safe bet, but maybe that one will earn 5%. Or maybe we would assess that with the required return of 5%. It's still better than we're getting at the bank. On the other hand, we say, we've got 10 shops, they're doing well. What if we open up an online distribution? Broadly similar products, but it's a completely new operation. We've got to sort out delivery, we've got to sort out warehouse, we've got software needed, we need all this new expertise. But if it works, we could make a bomb. Well, we say, let's look at the potential returns from the safe bet. The shop will apply a 5% cost of capital. Let's apply a 20% cost of capital to the estimated inflows from our risky project. Now, if even after 20% discounting, we find that the net present value is coming out strongly positive, then it may well be that the additional risk is probably worthwhile. So this is called risk-adjusted discount rates. You'll not be asked to calculate these, but it's a useful concept to be aware of. Net present value looks at the entire project. Yes, right up until the day the project finishes, all future cash flows are taken into account for the whole length of it. And that contrasts with payback, where payback we only look at to the point where payback occurs, and then after that we do no calculations at all. The downside of net present value, not as easily understood. Yeah, it's a topic that can be a little bit of an arcane science. If we're just given a pile of numbers, here, sort these out, without knowing what the numbers mean, plainly applying all those discount decimals does take longer. And we've just been talking about safe projects against risky projects. You've got to determine a cost of capital. So your starting point is, are we borrowing the money? And if we're borrowing it, how much are we paying for the use of those funds? That's our starting point. But then we need to adjust that, like we said, in terms of risk. Because if you can put money in the bank and get 4%, there's no point taking on a risky project also for 4%. So we need to determine what's a reasonable cost of capital. If we're too conservative and go over the top with too high a cost of capital, then we're never going to do anything. If we understate it, then there is a danger we take a lot of risks for not a lot of reward. Internal rate of return, broadly similar to net present value, does take into account time value of money. Doesn't require an exact cost of funds to be known. Well, yes, in that we don't need a cost of capital. We would actually use a range of different cost of capital figures, as we said, to estimate it. As a percentage measure, it is familiar. It is much easier to go to your MD and say, if we go for that, I reckon it'll generate a return of 12%, rather than going to him and saying, at a cost of capital, we will end up with a zero net present value for that if we use 12%. So most of us can understand the concept of put a few quid in and this is what we will earn on it. So it's a nice human friendly measure, rate of return. IRR is not ideal in situations with mutually exclusive projects or non-conventional cash flows. It's going to work best if you've got steady cash flows coming in from a project. Mutually exclusive projects mean you have a situation where we have project A, we've enough money to fund project A, or we can fund project B. And typically, if we've got a set amount to invest, we will have an idea of a set return. It tends to be easier just to see which one comes up with the net present value. Rate of return ignores the size of the investment since it's just a percentage measure. Yes, whether your figures are in thousands or millions, you just come up with a nice neat percentage. Counting rate of return is simple to calculate. Again, human friendly because it's a percentage. It does look at the entire project, and it reflects the way external investors will judge the organization. Most outside investors will be interested in how much will my money earn. If I put in 100,000, how much will it earn? So it's very much a return on money invested. Problem is, it doesn't take into account the timing of cash flows. It just looks at profit over the life of it. Profit can be influenced. You saw that one of the factors is depreciation. So profit is influenced by what your depreciation policy is. If you have very aggressive depreciation, you will get lower reported profit. If you are rather lax in your depreciation and you allow your asset values to be overstated, that will give a much more favorable accounting rate of return, which, not that directors would ever do anything like that, but if you're looking to encourage people to invest, there might be a temptation to look favorably. Finally, payback, as we said, payback only looks at how soon your money comes back. You could have huge cash flows 2 years after payback, takes absolutely no account of it. But what's nice is, rather crudely, it does allow for risk. If your project is going to pay back in 18 months, you've only got 18 months to worry, and after that, whatever happens, at least you've got your money back. yes, danger of payback is you might only start looking very short term, which is always a danger. So let's have a look at a typical task. Life of a project is 3 years. We're thinking of upgrading part of our factory. We've got to lay out £55,000 at the start, so that goes in as a negative. And as that's in today's money, we don't discount that at all. So £55,000 today is worth £55,000. Then each of our future cash flows coming in. So 36,000 coming in each year. 36,000 received in 1 year's time is worth 32,724 today. If we have to wait a further year, it's worth 29,746. Knowing that each of these factors is essentially the same calculation to the one before, I've just put 0.909 in my calculator. Press times to make it repeat. Put 36,000 in. I do equals once, I do equals twice, I do equals again. And in an exam, this will save me a lot of time and protect me against a lot of potential keying errors. If you have a Casio, they do that. If you haven't got a Casio, I don't know. Hey ho. So now we simply sum them up. 27.039. Add that to 29,746. You see what I mean? Add that to 32,724. 89,509. Take away the 55,000. Net present value is 34,509. So a quick question for the chat box. Oh, okay. 0.826 is simply 0.909 times 0.909. And 0.751 is simply 0.909 times 0.909 times 0.909. So I do 0.909 and press times. And on a Casio calculator, that sets a constant. If you've got a Casio, have a play. Now, so quick question for the chat box. We've just evaluated this using a discount factor of 10%. Is this project earning at a higher rate than 10% or a lower rate than 10%? Any offers in the chat box? Higher than 10% or lower than 10%? One brave candidate has popped head up above the parapet. Any more offers? You're absolutely right, Alice. It is higher because the net present value remains positive after discounting. It's doing better than 10%. So now with more aggressive discounting, you see that the future cash flows are worth considerably less. We're expecting a much greater return. I should just call a model answer, save all this effort, shouldn't I? 23706. So this time again, interesting. So we're still substantially positive at that. Now, what we could do, you recall the graph that we did before. So in this case, a slightly different situation in that we've actually got 2 points like this on our graph. but we could still do the same exercise and that same formula, and it would actually, I haven't drawn this terribly well. Let's try again. Okay. We've actually got 2 points on the graph, still both positive. So select the correct internal rate of return for the project. We know that it's higher than 10. We know that it's higher than 15. So we can rule that one out. The only way that I would feel safe answering this, I think, let's try it with 23.07%. So if we do 100 over 123.07, that gives us a year one factor of 0.8125. It's awkward. So I'm going to keep that on my calculator. So this is going to give us 29,251, 23,768, and 19,331 with rounding 3. So we've still got 55,000 minus. Really must write more neatly. 768, 251. Whoa. So it is higher still than 23.07. We can automatically rule that out. So it has to be that one. So that's a more typical question. We'll always end up with both sides of the line and know it's in between. But there you go. If you get one like that, that was quite a challenging one. See, we could rule out 13 because we know it's higher than 15. I just picked the middle one of the other three and it's come out higher than that. Hey, presto, job done. That was a tricky task. Avontac is considering an investment of £85,000 in new machinery, expected to increase profits over the next 4 years. And when you're given data of income and expense, remember that if it says labour savings, that's income. If it says it will incur maintenance costs, that's under outflow. So do read data carefully. You're looking for the cash difference each year, how much extra income or saving and how much saving or cost. So, read carefully. No further profits expected. The machinery will be sold. Now, that's significant because that does mean that at the end of life, when it's sold, we'll get some more money for it. So let's make a little note there so we don't forget that. So annual depreciation, straight line life of asset. So we're paying 85,000. Residual value is that 4 years. So that's going to cost us 20,000 each year. Annual depreciation. We require a 10% return on investment and a 25% accounting rate of return. So let's do our cash flows. Out goes 85,000, which is 85,000. Okay. Now, rather than rattle away on the calculator, 46,359, 44,604. Yep. 36,048. And remember, this final year, we've actually got to take into account the disposal proceeds. That's another very, very popular error. I wrote myself that note because that is so easy to forget. Once you get into the tap, doing the calculations, ever so easy to forget the disposal proceeds. So 52,500, and that's going to come out at 35,858. So we've got a huge net present value of 869. So this is telling us that our internal rate of return is considerably greater than 10%. So now here's where we've got to. Now, are they talking profit after? Okay. So far, so good. Now, our next job, here we go, and I've duplicated the data here. Our accounting rate of return. So we've got 4 profit figures here. So our profit in total over the 4 years . So we're going to make 111,000, which over 4 years is 27,750 average, which, if we look at our average investment, we invested 85,000, but we will get 5,000 back. So our actual investment nets off at 80,000. Which comes out 34.69%. We're not actually, are we told, we're not actually given how many. I was worked 2 decimal places unless instructed otherwise. So we require that. We've got that. So that's looking quite encouraging. So there we go. Okay, at that point, that's all the ground we have to cover tonight. I shall stop. Well, first of all, I should say thank you very much again for your attention tonight. I'll stop the recording at this point.